What happens when a company beats earnings, grows its hottest business by 32%, and still gets crushed by 20% in a single day? That's not a hypothetical. That's exactly what happened to Corning on July 28th, 2026. And if you own AI infrastructure stocks, or you're thinking about buying the dip, you need to understand why this happened before you make your next move. Here's the twist most people missed. This wasn't a bad quarter. Corning's core sales jumped 17% year over year to $4.74 billion, and EPS grew 30% to 78 cents, both beating what Wall Street expected. So why did the stock get demolished, falling as much as 20% intraday, marking one of its sharpest single-day drops in years for a name that had become the poster child for the AI build-out trade? Stick around, because by the end of this video I'll show you why I think this sell-off is actually a gift, not a warning sign. This video expands on my recent article for Barchart. The link to read it fully is in the description. If you're into stocks and markets, hit that like button and subscribe for more breakdowns like this. Let's get into it. Let's talk about the number that actually tanked this stock, because it wasn't the earnings, it was the outlook. Corning guided third quarter core sales to $4.9 billion to $5.0 billion, which is 16% year over year growth. But that came in just a touch below the market's sky-high consensus estimates. In a market that's been pricing Corning for perfection, a touch below is apparently all it takes to trigger a stampede for the exits. Now here's the piece that really got investors nervous. Corning's optical communications segment, the business tied directly to AI data centers, grew 32% to more than $2 billion in the quarter. That sounds great until you realize it's decelerating from 36% growth just one quarter earlier. Investors read that as the first real crack in the hyper-growth story, and honestly, when a stock has run up over 60% year to date, the market doesn't forgive deceleration easily. But before you panic and sell, let's put that valuation in context, because this is where it gets interesting. Corning's forward price to earnings ratio sits at 38.58 times, well above the sector median of 23.04 times, and its price to sales ratio of 6.83 times dwarfs the sector median of 3.26 times. Yes, that's expensive, but you don't pay a premium multiple for a company standing still. You pay it for a company with contracts already locked in, and Corning has locked in a lot. The company signed a multi-year partnership with NVIDIA to expand US optical connectivity capacity by 10 times, and a multi-billion-dollar, multi-decade deal with Amazon to ramp up fiber optic production for data centers, creating thousands of jobs, including 1,000 in North Carolina. Layer on top of that Corning's own Springboard roadmap. Management is targeting a $20 billion annualized sales run rate by the end of 2026, pushing to $30 billion by 2028, and a high confidence path to $40 billion by 2030. If you're keeping score, that's not a company losing the AI race. That's a company that just had one guidance quarter that didn't match Wall Street's overheated expectations. Drop a comment below. Do you think Wall Street's estimates were just too aggressive going into this print? On the analyst side, the backdrop actually stayed supportive through the chaos. Citi's Asia Merchant maintained a buy rating back on April 9, 2026, with a $170 price target, and the broader consensus of 14 analysts still rates Corning a moderate buy, with an average price target of $195.93. That's roughly 39% upside from current levels. So while retail investors panicked on July 28th, the professionals largely didn't blink. The long-term Springboard targets remain intact. Management is not walking those back. Could growth slow further? Absolutely. If hyperscaler capex pauses or optical component pricing comes under pressure, optical communications will feel it. That's the clear risk. But so far, the numbers show continued double-digit growth and expanding margins, not a cliff. Quick question for you. Are you treating this 20% drop as a warning or a discount? Drop your take in the comments. I actually read them. Here's my honest read. The bull case. Corning has real, signed contracts with Nvidia and Amazon, a credible path to $40 billion in sales by 2030, and analysts still see 39% upside from here. The bear case. At 38.58 times forward PE means there's zero room for another guidance stumble, and the optical communications deceleration from 36% to 32% growth could be the start of a real slowdown, not just noise. My bottom line, I treat this pullback as an opportunity to build a position gradually, not all at once. For investors who can stomach volatility, the post-earnings levels look more reasonable than the June highs did. This is not financial advice. Always do your own research before buying any stock. Past performance does not guarantee future results. If this helped, smash the like button, subscribe, and turn on notifications. Drop a comment. What do you think about Corning stock? Which stock should I cover next? I will see you in the next